Per tradition, we have the Wipro management with us to talk about the quarter gone by. Thank you so much, gentlemen, for speaking to us. As always, I'm going to take my first question to Abid. Abid, tell me about the guidance. You know, last time around when we spoke, you had said that by the end of this year, that is by this particular quarter, you would be able to match up to industry matching growth rates. The guidance has a lot of areas of caution. So specifically, why is the guidance lesser than what the street was expecting?
Kritika, first of all, thank you for having us on the program. As I said, I'm myself disappointed with our guidance. And there are 2 or 3 factors at play in our guidance. And as I've always said, our guidance reflects what we see at the time that we give the guidance. So one factor is a surprise that we had of, unfortunately, 2 bankruptcies of our clients hitting us in the same quarter. If you remember, the first bankruptcy hit us in the first week of last quarter, and the second bankruptcy hit us in the last week of last quarter. Obviously, we took the margin hit emanating out of those bankruptcies in Q4, but the run rate revenue hit is reflected primarily in our Q1 guidance. The second one is HPS, our platform which caters to the US Affordable Care Act exchange business, has continued to see exits for reasons that are very well known, primarily having lack of legislative clarity in what happens with ACA, and because of that, some of our customers who are the insurance companies decided to exit, and those exits hit us both in Q4 as well as in Q1. That has had an impact. And the third one is a seasonal softness in the India and Middle East business that we have in Q1 has contributed a little more than what we would have expected. So those kind of 3 things coming together has been a perfect storm for our Q1 guidance. Although I'm quite hopeful from a long-term perspective, all of our strategic levers, whether we talk about our digital growth, which has been 9% quarter on quarter on Q4 and has grown over 27% year on year. That momentum continues. We are seeing a lot of larger digital deals. Our order booking in Q4 and through FY18 has been very robust, and that gives me confidence that the revenue conversion will take a quarter or so, but will start showing up in Q2 onwards. Overall, our account mining continues to be very good. Our top clients, the top 10 clients, have grown quite well at about 15%. So overall, I see a very good momentum, and that gives me confidence that we will return to growth Q2 onwards, and we will work through Q1 to execute on our strategy.
I like how honest you're being about the outlook, Abid. So by Q2, are you going back to the fact that by the second quarter of FY19, you will be back to industry matching growth rates on a quarterly basis?
So, Kritika, I've said it once, so I don't want to jinx it by saying it, but we will work towards executing on our strategy, and you know, the numbers will show for themselves.
Okay, but the headwinds that you are seeing at this point in time will start abating themselves by the second quarter.
That is right. The HPS piece has been a continuous surprise and disappointment for us. And you know, if you would remember, when we acquired it for 3 quarters, we grew it continuously very well, and it was at some point in time over $70 million of quarterly run rate, which is now in the low 30s. So it still worries me how it pans out. India, Middle East, I feel quite good that, you know, we are on a path of our restructuring where we are changing what we sell in the market quite significantly into digital and consulting-led transformation compared to some of the work that we did historically as Wipro Infotech in a lot of hardware and product-led services around infrastructure. So those things are panning out well, but you know, there is a rhythm to some of the legacy business declining versus some of the new business getting acquired and delivered, both in terms of the size of the deals as well as in terms of the speed at which both of these happen. So those are some things which we have built in our business model, because there will always be 1 or 2 verticals which are soft and other verticals which kind of compensate for them. But when things like bankruptcies or an HPS kind of unanticipated situation and uncertainty comes in, it becomes a little more difficult to be able to overcome, especially within the same quarter.
Okay. Jatin, let me ask you about the margins. As far as the margins are concerned this time around, adjusted margins, yes, are 16%. But if you look at the impact of the insolvency and the impairment loss that you took in, it's actually coming at a consolidated amount of 14.4%. So how much of this is likely to continue and trickle into Q1? And can you give us a breakup of the margins and the impact that you've seen this quarter?
Sure, Kritika. So if you see our reported margins of 14.4, and if you adjust this to impacts, you will be at 16%. So effectively, that's the normalized margin. And compared to quarter 3, we are lower by about 120 basis points, of which about 50 is from forex and 50 is from the volatility in India and Middle East business, and partially from health plan services. So this is where this is how the margin stacked up for quarter 4. Going forward, if you see our operating parameters, they reflect good health. The utilization is very good. Offshoring has been quite good. We also have had a good year in terms of productivity that we have driven our quarter 4 last year to quarter 4 this year. The revenues have increased by about 5%, 5.5% with a reduction in headcount. So overall, we have driven good productivity. So the core business remains fairly stable vis-a-vis operating margin. We need to weather through the noise and the external volatility which is impacting our India and Middle East business and health plan services business in medium term as we work through this year. Specifically for quarter 1, we would have headwinds of lower revenues as we have guided, and we will also give salary increases from 1st June, and that will also impact on the margins for quarter 1.
You know, Jatin, I know you don't give guidance for margins, but is there a range that you are aiming towards? Is there an aspirational target that you're ranging towards for FY19?
Kritika, one would love to give a range, but we are going through many moving parts. So this year, I think it's much better to build a base, execute through the quarter, and build further on that in next quarter. So one would do that in a year like this, and not give an external range that one would want to reach.
Okay, fair enough. Bhanu, I want to build on the point that Abid was making on the fact that you've actually seen a better order flow as far as digital deals are concerned in Q4 than you have in recent times. So help me understand the kind of scale in terms of digital deals. 9% growth on a Q-on-Q basis is definitely significant. Are you expecting the pace and the scale to grow here on, and how large is this looking like? Because this is the one thing, Bhanu, that analysts seem to want to understand about. How large is the order book looking like for digital?
Yeah, so Kritika, our digital business is doing extremely well, like you said, and our order book gives a good momentum for the growth as well. Today, our digital business is almost 27% of our revenues, and we continue to see good momentum in the growth pattern for the digital business. It is primarily governed by the multiple things that we have done on the digital side. One, in terms of building capabilities that are very relevant for our markets. 2, customizing those capabilities for the digital journeys that our customers are taking in specific verticals. 3, establishing digital pods for customers where they can experience these digital solutions very quickly. And 4th, the entire delivery mechanism of building people, ensuring that they have the right skill sets and capabilities, and delivering these projects extremely well. So we have put all the foundation blocks required for making this digital business accelerate faster. Obviously, there is a great pull for the services that we are delivering right now. So the confidence on the digital business doing very well is very high for us right now.
Okay, fair enough. Saurabh, I want to ask you, the question that I always do. Attrition has gone up a little bit this quarter. Is it because of a seasonal impact that you have? Of course, Q4 is seasonally weakish for attrition. And in terms of the utilization, Jatin was pointing out on how utilization has actually inched up margin. So what more scale is there over there?
So on attrition, you're right. Q4 seasonally is a higher attrition quarter after Q3 where there's less of attrition, and we are seeing a slide. But if you look at over the last 8 quarters, attrition has moved on in a 1% band, so it is fairly stable. Where we are looking at and where we want to focus is on the right skills and make sure that we don't lose the people with the right skill sets, and that's critical, especially in the new areas like digital and others. And as Jatin mentioned to you, we would be going with a salary increase there, effective 1st January, in line with the industry. 1st June this quarter. As far as utilization is concerned, we are on a 13-quarter high. Last time I had mentioned to you that we have headspace. I still feel it's a big lever for us amongst the other things to help improve our margins, and we'll continue to work on this area. Offshoring is improving. So very clearly, we have the levers to look at our overall margin perspective. Attrition, I think, is very stable across the organization. Slight blip, but nothing it's more a seasonal issue from a quarter standpoint. And looking forward to good increases for the right people to make sure that we arrest the attrition in the right places.
Okay, gentlemen, thank you so much for a very honest and clear conversation about the 4th quarter, and good luck for the next 1 year. We're completely out of time, so unfortunately have to cut short this conversation. Thank you so much and good luck for FY19.